Just now, the COMEX silver vault just dropped another 6 million ounces. And at the exact same moment, the CME cut silver margins. Two events, same timing. And the one question every serious analyst is quietly asking, but almost nobody will answer publicly, is the only question that actually matters right now. Why slash margins right before the most important jobs report in years? Tomorrow, the February non-farm payrolls report from the Bureau of Labor Statistics drops at 8:30 a.m. Eastern. And the timing could not be more dangerous for the U.S. economy. Economists are expecting a major slowdown in hiring. Consensus forecast, 60,000 new jobs. Previous month, 130,000 jobs. That is a 54% collapse in hiring in a single month. Unemployment is expected to hold at 4.3%, but that number hides the real question the market is asking. Is the economy cooling or cracking? Because right now, the macro backdrop is unlike anything we've seen in years. War escalation, energy price shocks, tariffs reshaping global supply chains overnight, and a Federal Reserve facing a nearly impossible choice. Right now, the CME FedWatch tool shows a 98% probability the Fed holds rates unchanged this month, because inflation pressure and recession risk are now pulling in opposite directions at the same time. And right before that binary macro catalyst lands, right before the NFP hits a silver market that just crashed 11% and then bounced 4% in 48 hours, the CME cuts margin requirements. That is not routine. That is a signal. And understanding that signal before the number prints is the difference between reacting to the market and actually understanding what the institutions are doing underneath it. This is John OG. There are copycats everywhere trying to imitate this format to sell you scams. One name, one identity, John OG. This channel has never sold a course, never sold signals, never sold memberships, and never will. If you are new here, subscribe right now, because the combination of a 6 million ounce vault drop, a CME margin slash, and a binary NFP catalyst landing on the same Friday is the most specific 3-variable setup the silver market has produced in weeks. And you need to understand all 3 before the session opens. Drop OG in the comments if you saw the vault drop before this video explained it. One word that tells me you're reading the primary data, not waiting for someone else to interpret it for you. Let's go. Official depository statistics from COMEX confirm a major drawdown in silver inventories. The exchange reported a single-day negative adjustment of 3,256,882 ounces in registered silver. That pushed total registered inventory below the psychological 100 million ounce level for the first time. At the same time, vaults reported more than 4.7 million ounces withdrawn from the eligible category. Add those together and you get the headline number. 6 million ounces gone in one session. And this is not an isolated event. This is part of a pattern that has now been running for weeks. Not a single day of net inflow into registered silver. In the past month alone, registered inventory has dropped dramatically, and the metal did not move into eligible storage. It left the vault entirely, not reclassified, not reassigned, not converted, gone. Out of the COMEX system into private custody, into industrial supply chains, into anywhere that is not a COMEX-approved warehouse, where the exchange can change rules, raise margins, or force cash settlement. By the end of February 2026, registered silver stocks had fallen to 86.1 million ounces, a 31% collapse from levels seen only months earlier. Now here is where the delivery math starts to get uncomfortable. On the first notice day for the March silver contract, delivery notices were issued for 10,526 contracts. That represents 52.63 million ounces of silver, more than 60% of total registered inventory demanded in the first 48 hours of the delivery window. And now the vault just dropped another 6 million ounces. The math here is not complicated. It is not theoretical. It is simple arithmetic. And arithmetic does not negotiate with margin policy. Now let's talk about the second signal, the CME margin cut. After silver's historic rally, fueled by leverage, momentum, and speculative flows, the exchange raised margin requirements from 15% to 18% earlier this year. That forced traders to post more collateral. Many couldn't. Positions were liquidated. The result was a cascade. Silver collapsed from $121 to $79. Speculative open interest dropped 77% year over year. The leverage was flushed. The crowded trade was cleared. The margin hikes did exactly what they were designed to do. But now something changed. Silver is trading around $85. Speculative positioning is at historic lows. Physical delivery demand is running 7 times historical averages. And suddenly the CME cuts margins. Why? Because margin requirements are now calculated as a percentage of contract value. When silver rises, required margin rises automatically. But when the exchange cuts the percentage, the cost of holding a futures position drops immediately. That means one thing. The exchange has determined that clearing risk at current prices is manageable. And for institutional traders watching from the sidelines, hedge funds, managed money desks, macro funds, that margin cut is the signal they were waiting for. Because holding silver futures just became cheaper, and cheaper leverage changes positioning behavior. Now step back and look at the bigger structural problem. Silver supply is fundamentally inelastic. Roughly 70 to 80% of global silver production is a byproduct of mining other metals: copper, lead, zinc, and gold. That means silver production does not respond quickly to higher prices. If copper miners cut production because copper prices fall, silver supply drops too, regardless of what silver prices are doing. The supply response timeline is 7 to 10 years, but the delivery demand timeline is right now, and that is why today's 6 million ounce vault withdrawal matters more than similar events in other commodity markets. The metal leaving today is not easily replaced. Now let's talk about tomorrow. The non-farm payrolls report, 3 possible scenarios. Scenario 1, NFP misses badly, below 60,000, possibly negative. This is John OG.